Hello, it's a very lovely good evening from here in Delhi and hope that each one of you are absolutely fine. So now in this particular session, as I promised you, we are going to pick up some very strong questions, and these questions are related with intrinsic value of method, and of course in your module 2 the questions have been given, and all these questions have been taken from your module, which we are going to do actually in this particular session. 6.2. Indirectly it also means actually that intrinsic value of method is quite important, significant, and of course some formidable questions strike in the examination, so you need to have a very good idea and of course thorough grounding with respect to this particular topic. We start off with 6.2. 6.2 taken from module, adapted from past examination papers, and modified in the sense that I sometimes change the dates and of course the names. F1 Limited agreed to take over F2 Limited as at 1/10/2020, and the summarized balance sheet of F1 and F2 Limited as at 31st of 3/2021 is given to you. So balance sheet is given on 31st of 3/2021. It means accounting year must have started on 1/4/2021. Besides that, we have been given that F1 took over F2 Limited on 1/10/2020. Correct? Not on 1st April 2020, but almost 6 months later. Now, item given to us is equity, 20 lakh and 15 lakh. Besides that, the question then runs to the next sheet. Further, we are given that reserve and surplus. Reserves of these two companies are 390, 340, then profit or loss account and creditors. Besides that, we have got in this case current asset in the form of stock, debtors, bank, and preliminary expenses. Preliminary expenses is given in the balance sheet. It was given in the module. So I have also written over here. Otherwise, nowadays, it is very difficult to find preliminary expenses in the balance sheet because the existing accounting standard AS 26 very clearly states that preliminary expenses, as far as possible, should be written off against your existing profit or loss account, reserves, or whatever it is. Additional information now is given to you for the first 6 months from the 1st April 2020. For the first 6 months period from 1st April 2020, F1 Limited and F2 Limited made a profit of 5,40,000 and 3,60,000 respectively after writing off depreciation at the rate of 10% per annum on their fixed asset. Now the very first line actually requires bit of discussion in the sense that I will take a rough sheet actually simultaneously to explain the question and so that you understand it better. Correct? First of all, what is given to us, just let me actually fix up the rough sheets down over there. Now in this question, so far what is given to us is that accounting year, as I told you, is commencing from 1/4/2020 and it is ending on 31st of 3/2021. Correct? We have been told that F1 Limited took over F2 Limited on 1/10/2020. This is your date of acquisition, you may say so. Correct? Further, question states that in the first 6 months, F1 Limited took over F2 Limited on this date, 1/10/2020. In the first 6 months, what is happening in this question has just stated below that in the first 6 months, actually, just wait actually, lots of seeds sometimes actually creates problem. Okay. For the first 6 months period from 1st April 2020, F1 Limited and F2 Limited made a profit of 5,40,000 and 3,60,000 respectively after writing off depreciation at the rate of 10% per annum on their fixed asset. That means in the first 6 months, as I talked about, from 1st April till 1/10/2020, both the companies made profits. F1 Limited made a profit of 5,40,000 and F2 Limited also made a profit of 3,60,000. And these profits were earned by both these companies after writing off depreciation of 10%. After depreciation of 10%. Both these companies earned profits of this much in the first 6 months. Correct? Further, it is also given that both the companies paid on 1st of August 2020 equity dividend of 10% and dividend tax at 15% was paid by each of them on such payment. Because your module still contains this line, so I haven't changed it. However, nowadays, as you know better than I, actually, there is no dividend tax. Instead, there is TDS. But anyway, so on 1st of August, obviously, August will come before October. So in the month of August, what is happening? Both these companies actually declared dividend. A dividend was declared. It is also given dividend. Dividend at the rate of 10%, and along with that, dividend tax of 15%. Correct? Both these companies declared a dividend of 10% and dividend tax is at 15%. Further, it is also given to you that goodwill of F2 Limited was valued at 1,68,900 on the date of takeover. On the date of takeover, this is the date of takeover. On this date, question states that goodwill of F2 Limited, because F2 Limited was taken over, its goodwill was determined at 1,68,900. This is what given to us. Further, question states that stock of F2 Limited subject to an abnormal item of 8,500 to be fully written off would be appreciated by 20% for the purpose of takeover. Now look into the balance sheet. The stock of actually F2 Limited happens to be 3,81,500. What does this particular line mean? On the date of takeover, stock which is reflected in the balance sheet at 3,81,500. I'm talking about of F2 Limited. Now, as per this line, a stock of F2 Limited subject to an abnormal item of 8,500. Subject to an abnormal item means this stock contains some abnormal item and its value is 8,500. It should be written off. So, when I will write it off, my stock will come down to 3,73,000. And then question says that after writing it off, it would be appreciated by 20% for the purpose of taken over. So now I will take 20% of this one, 3,73,000. It will be equal to 74,600. And if I will add it, it will be equal to 4,47,600. That means stock of F2 Limited was taken over at this particular value. Is it clear to you or not? This is what we mean by this particular line. Then question states that F1 Limited would issue F2 Limited's shareholders fully paid equity shares of 10 each on the basis of comparative intrinsic value of share on the date of takeover. So that is why the concept of intrinsic value is very important, because most of the question which we see even in your module and even in the examination actually they strike from this particular topic. You are required to calculate consideration to be transferred by F1 Limited, number one, and we have to calculate the number of shares to be issued by F1 to F2 Limited. That's what exactly I told you. Generally in the question you won't be asked to prepare ledger accounts or to what we call pass entries or something like that. You will be simply asked the computation of what we call number of shares and the amount of consideration. Now you think for a while how you are going to compute the consideration and how you are going to compute the number of shares to be issued by acquired company F1 to F2 Limited. For that, you will have to first of all compute intrinsic value of share on the date of takeover. Now date of takeover is actually 1/10/2020. So on this date you need to know their assets and liability. Problem is that we have been given balance sheet on this particular date. Is it clear to you? The extract of balance sheet is given on 31st/3/2021. But for the first 6 months adjustment we will have to actually made in this particular question, isn't it or not? So now what I am going to do is, first of all, let me start the question. So this is your rough sheet, but still I would love you to actually note down whatever actually I wrote down over there. I will keep this sheet here in front of me so that in case if I need to have a look, I shouldn't have any problem. So now we can start the question. 6.2 is the question, correct? Question number 6.2. In visualizer, actually Setting the sheets is very difficult task. Question number 6.2. As I told you, this question has been taken from module. This question has also struck in the past examination. So under the first step, what actually I am going to do is just pay attention. First step. Actually, I just want to know the increase in profit. What we mean by increase in profit, just pay attention and why I am computing it. I will let you know in a short while. Because in this case, what is happening that we have been given information in the first 6 months, some changes have taken place. Some changes have taken place in the first 6 months, correct? So accordingly, I will have to adjust those changes. We have been given that in the first 6 months, both the companies earned net profits of 5,40,000 and 3,60,000, as I told you. This profit was earned after writing off depreciation. Suppose if I add depreciation to it once again, do you remember under your cash flow statement while computing the cash flows from operation, you used to add your non-cash items? So this is exactly what I am doing, because this net profit is after depreciation and depreciation is a non-cash item. So I just want to know actually how much cash profit we have earned. Now, as far as F1 Limited is concerned, look into their column and their fixed assets are 15,50,000. And rate of depreciation is 10%. And for the first 6 months, what will be the depreciation? The depreciation will be equal to 77,500. And then I will compute for F2. Value of tangible fixed asset, it's 12,60,000, correct? 12,60,000. Rate of depreciation given to us is 10%. For the 6 months, depreciation will be equal to 63,000. When I add the depreciation, it means profits, that is cash profit, must have been equal to 6,17,500. This is our cash profit. And 4,23,000. So first of all, I have computed that during the first 6 months, how much profits actually both these entities have earned. Now, as I told you, we are in a position to know the balances, especially their cash balances. Because of profits, cash will get impacted. So I just want to know what was the balance in cash on the date of acquisition. That should be my second step. As far as your second step is concerned, under it, what I am computing, that is cash balances as on 1/10/2020. Correct? 1/10/2020. Here I write F1, then I write F2. We have been given balance as per balance sheet. Balance as per 1/4/2020. I look into the balance sheet. Actually, you do one thing. It seems actually there is a slight mistake in this question as far as dates is concerned. Balance sheet of F1 and F2 as at 31st/3/2021, you make it as 31st/3/2020. Correct? 31st/3/2020. Otherwise, this question will not be in tune with the information which is given. So, balance sheet is as per 31st/3/2020. So, we can say 31st/3/2020 or 1/4/2020 is similar date. So, I will look into the balance sheet. I try to find out what was the amount of cash balance. That is 3,40,000 for F1 Limited. and 1,80,000 for F2 Limited. Correct? Now, as we know, increase in cash profit is nothing but increase in cash. So I write here increase in cash profit. Increase in cash profit means increase in cash. Correct? Now, increase in cash is 6,17,500 and 4,23,000. 4,23,000. Now the total comes to 9,57,500 and 6,03,000. Question also states that in the month of August, both the companies actually made payments for dividend. So when we will pay the dividend amount, what will happen? What will happen? Our cash will reduce. So payment of dividend. Payment of dividend. Total share capital of F1 Limited is 20 lakhs and rate of dividend is 10%. So they must have paid dividend to the tune of 2 lakhs. Besides, it was given in the question that dividend tax, correct, is 15%. Dividend tax is always imposed upon the amount of dividend. This company paid the dividend amounting to 2 lakh. So what will be the dividend tax which this company would pay? That would be 15% of 2 lakh, quite obviously in this case. So dividend tax will be equal to payment of dividend and dividend tax, as you call DDT. That is amount of dividend is 2 lakhs, so 2 lakh into 15%. That will be equal to 30,000. Similarly, we will have to compute dividend payment for F2. Share capital of F2 Limited was how much? Share capital of this company is, let me check it down, sometime I forget, 15 lakh. 15 lakh into 10%. So F2 Limited will make a payment of dividend to the extent of 1,50,000. 1,50,000, correct? 1,50,000. Then dividend tax will be equal to, dividend tax will be computed on the amount of dividend and it is at the rate of 15%. So 15% of 1,50,000 will be equal to 22,500. So when we will make the payment for dividend, our cash amount will reduce. Correct? So now I may say that cash balance of F1 Limited is 7,27,500. And cash balance of this particular company is 4,30,500. 4,30,500. Is it clear to you or not? Yes, sir. Why these two steps are important? Because you have taken over the other company on 1st of October. So on 1st of October, what was the position of their balance sheet? Actually, no other item is getting affected besides cash, and of course, their fixed asset will also get affected because there is some depreciation in it. So, in order to know the position of the balance sheet on 1/10/2020, the date of acquisition, we needed to actually go through these two steps. Correct? So now we are in a position to compute the intrinsic value of share. So this is your step number 1 and 2. Now we are in a position, as I said, to compute intrinsic value of share. In order to compute the intrinsic value of share, step number 3, actually, first of all, let me write here. Step number 3. Then I will write here computation of intrinsic value of share. Computation of intrinsic value of share. One is F1, another one is F2. First of all, I write here cash balances, cash bank, whatever it is, as per step number 2. We computed 7,27,500 is the balance of F1 Limited and 4,30,500 is the balance of F2 Limited. Now all we have to do is to look into their balance sheet. In the balance sheet, we have been given tangible fixed asset, or simply you can write property, plant and equipment. Correct? Less depreciation. Less depreciation. What I mean to say, in the balance sheet, tangible fixed asset is 15,50,000. Correct? And for the first six months, because from the date of acquisition, from the date of beginning, 6 months later we took over. So we will have to apply depreciation for 6 months. So I will apply depreciation for 6 months and subtract it from 15,50,000 to compute the value of fixed asset on the date of acquisition, and so on. Correct? And we computed the depreciation, if you remember, when we computed actually net profit. Now 15,50,000 minus 77,500. So that will be equal to 14,72,500. That is 15,50,000 minus 77,500. Similarly, tangible fixed asset are given to you of this particular entity is equal to 12,60,000, and you charge depreciation of 63. So 12,60 minus 63 will be equal to 11,97,000. 11,97,000. Then we have been given debtors. As far as current assets are concerned, debtors is equal to 3,49,500 and 2,31,000. 2,31,000, correct? Then stock. As far as stock of F1 Limited was concerned, there is no problem in it, 5,35,500. However, the stock of F2 Limited was taken at a revised value, and in order to compute the revised value, we subtracted abnormal item 8,500, and whatever remaining balance was there, we appreciated it by 20%, and we got the figure of 4,47,600. Is it clear to you or not? Then don't forget to write goodwill, because cash balance we have already written. Because goodwill, it was given to us of F2 Limited, was valued at 1,68,900. So now you have to total all these items. When you will total all these items, you will get 30,85,000 and 24,75,000. So now you have arrived at the aggregate value of assets. All you have to do is to now subtract the what we call creditors. As far as creditors are concerned, it is given to us 85,000 and 75,000. By subtracting these items from the aggregate value, we will get net assets. Net assets for shareholders. Net assets for shareholders will be equal to 30 lakhs. Correct? And of course 24 lakhs. There is no preference share capital in this question. So 30 lakh will also be the amount for equity shareholders. And likewise 24 lakh for F2 Limited. This is net assets for equity shareholders. Equity shareholders. Is it clear to you? Now we will divide it by the number of shares. If I am going to divide it by number of shares, total share capital is 20 lakh and one share is of rupees 10 each. So the number of share must be equal to 2 lakhs. And similarly, in this case, 15 lakh divided by 10, number of share must be equal to 1,50,000. So now we are in a position to compute the intrinsic value of shares. So intrinsic value of share of this particular company will be 15 lakh, rupees 15 per share. Rupees 15 per share, and of this company will be equal to 16 per share. Second point is, and question has also asked us to compute the amount of consideration, which we have already computed, is step number 4, consideration. Consideration is nothing but net assets. That is, net assets, obviously, of F2 Limited. So net assets of F2 Limited is equal to 24 lakhs. Now the next question is, in order to discharge consideration of 24 lakh, how many number of shares shall be issued by F1 Limited? So all I need to do is to divide it by intrinsic value of F1 Limited. Intrinsic value of share of F1 Limited. Now intrinsic value of F1 Limited is rupees 15. So in order to discharge consideration of 24 lakh, I will divide it by 15, and that will give me number of shares to be issued by F1 Limited to discharge consideration. To discharge consideration. If I divide 24 lakh by 15, it will be equal to 1,50,000. It will be equal to, let me see actually, will it be equal to 1,50,000 or not? I think it will be equal to 1,60,000. So 1,60,000. 1,60,000 shares, of course, of rupees 10 each at a premium of 5, we will issue. This is what we mean by it. So this is exactly the demand of the question, the amount of consideration, and how many number of shares will be issued by F1 Limited to discharge the consideration. So that is how you will have to present the solution of this particular question. Correct? Now we move over to another very strong question. This was question number 6.2, and now the next question is 6.3. Just wait. Keep the sheets here. Now I will look into the notes, and notes are lying over here. So 6.3 now we pick up. 6.3. 6.3, again this question has been taken from module and from past examination paper, and of course modified. Modified because of the changes in date, you may say so. The summarized balance sheet of W1 and W2 as on 31st of 3/2020 is given to you, and W2 Limited was merged with W1 Limited with effect from 31st of March 2020. Information given to you is that equity share capital of both these companies is as follows. Then as far as reserve and surplus is concerned, we have been given general reserve, profit and loss account. As far as non-current liability is concerned, we are given 12% debentures, and as far as current liability is concerned, we have two liabilities, sundry creditors and provision for taxation. Then under the non-current asset, we have fixed asset or property, plant and equipment. Then investment, which is non-trade, it is nowadays called as financial asset. So investment is 150 and 50. And under the current asset, we have lots of current assets, stock, debtors, advance tax and bank. Besides, there's once again preliminary expenses is also there. W1 Limited would issue 12% debentures to discharge the claims of the debenture holders of W2 Limited at par. What does it mean? It means once W1 will take over the W2 Limited, it means we will take over their assets and liabilities. after taking over their assets and liabilities. When we say we are taking over their assets and liability, obviously we are taking over their assets and all the liabilities, and in the liabilities we will take over their debentures, creditors and provision for tax, no doubt about that. After taking them over, we will discharge these debentures, and in order to discharge these debentures, actually we will issue our company's debenture. That is what we mean by it. W1 Limited would issue 12% debenture to discharge the claims of the debenture holders of W2 Limited. Further, we have been given non-trade investment of W1 Limited fetched 20%, while those of W2 Limited fetched at the rate of 12%. What does it mean? You have been given investment. Investments are always, even though I have written here non-trade, remember one thing, whenever investments are given in balance sheet, it always means non-trade. Why it means non-trade? Because when I'm going to invest somewhere else, first of all, what does investment means? Investment means you have invested your money in some other company's financial instrument like shares, bond, debentures. So it means the amount which you have invested in other entity is actually being used by the other entity. It is not being used by you. That is why investments are always non-trading, whether word non-trade written or not. But you have to be very cautious. What I mean to say is that even here, if in the bracket word non-trade would not have been mentioned, you should have known that these investments are non-trading, because investments are always non-trading. Reason being is that your amount, your resources are being used by some other entities. You are not using this asset for the sake of your business. Your money is being used by other entity, and obviously in turn you are going to get some return in the form of dividend or interest. That's a different matter. 99.99% investments are always non-trade. However, investment could be trading only if in the bracket it would be written for replacement of debentures, for redemption of debenture, or for replacement of a particular asset. If in the bracket sometime on rare occasion it may mention that investment for the purpose of redemption of debenture or investment for the purpose of replacement of an asset, in that case investment will be considered as trading, because in that case the intention is that even though we have invested the amount, ultimately we are going to use that amount for the what we call affairs of our operations. So that is the reason. So you need to be very careful that investments are always non-trading, but when it could be trading, that is the point which you need to know. However, in this case investments are non-trading. Further, you have been given that W1 Limited's investment of fetching a return of 20%, while investments of W2 Limited is fetching a return of 12% only. Now you have been given some important information. Profit pre-tax, that means all these profits are pre-tax profits of W1 and W2 Limited during 2019, 20, 2021 and 21-22. So profits of last 3 years is given also. Why these profits are given, to be very honest with you, even till up to this particular point of time, we even do not know. But let's see, sometime profits of past years are given, perhaps because of computation of goodwill. So this could be the situation here also, and this is the situation. Goodwill may be calculated on the basis of capitalization method, taking 20% as the pre-tax normal rate of return. So question has asked you to compute the amount of goodwill on the basis of capitalization method. As you know, in order to compute goodwill under capitalization method, first of all, I need to compute the operating capital employed. Operating capital employed means all operating. In simple words, it means all trading asset less liabilities. By subtracting liabilities from trading asset, and trading asset indirectly means you are not going to consider any non-trading investments. That is the point here, and that was the reason actually why I was trying to tell you what exactly are non-trading and trading investments. So first of all, you'll compute the operating capital employed. Once you have computed the operating capital employed, then you are going to compute, of course, your average profits, correct? And these average profits are given to you as pre-tax profit. When you will compute these profits, you will have to subtract the income from investments. Why? Because investments are non-trading. So any return which you are getting or which you must have got during the last 3 years, you must subtract it from these profits, correct? In order to get your operational profit. So once you have got what we call your profits, then all you have to do is to divide it by 20% as pre-tax normal rate. Actually, in this question, profits are pre-tax and even your normal rate of return is pre-tax. Correct? Now suppose if your income tax rate would have been given, then the average profit which you would have had computed, first of all you would have subtracted the what we call tax, then you would have computed the profits after tax, and similarly the pre-tax rate would have been what we call made as after tax rate, and then you would have capitalized the amount of profit. How we do that, we are going to see it in this balance sheet, in this particular question. Question has simply asked us to prepare balance sheet of W1 Limited after the merger as per Schedule 3 of Division 2. Of course, right from the beginning of this particular chapter, we are following Schedule 2. Correct? So this is the question. The basic difference between the last question and this question is that here in order to compute, but before that one line actually I haven't gone through, and which is quite wider. Purchase consideration is discharged by W1 Limited on the basis of intrinsic value of per share. So point is that first of all I will have to compute the goodwill, because this time W1 Limited is taking over what we call W2 Limited. Here it is written in your notes must be W1 Limited and W2 Limited. Let me correct it. So these are the profits. The profits are given to you for the computation of the goodwill. Once you have computed the amount of goodwill, then you will compute the amount of intrinsic value of share, and then you can easily actually compute the number of share which you are going to issue. Correct? So this is the question, strong question, but at the same time, as I told you, once your groundings are very strong, no question should appear to you as very tough. Since I believe that we have acquired sufficient amount of and very creditable amount of efficiency, so I don't think that we are going to face any problem as far as this particular question is concerned, and I hope that each one of you would agree in this regard, isn't it? So question number 6.3. Question number 6.3. This is the question which we are picking up now. In order to compute the amount of goodwill, first of all, actually what I am going to do, I am going to compute the operating capital employed. In order to compute the operating capital employed, step number 1, and why I am computing it, I told you because ultimately I need to compute the amount of goodwill, operating capital employed. I will have to compute the operating capital employed. In order to compute the operating capital employed, first of all, I will write here F1 and then of course F2, W1 and W2, sorry. Actually, I will have to write all the assets, but instead of writing all the assets, I take a shorter approach. What I write here, say, total of asset side. Instead of writing all the assets and wasting our time, we can simply write total of asset side. Now, total of asset side is given to us as 17 lakh, and 7,80,000. 17 lakh and 7,80,000. This is given to us, correct? Total of asset side. Now, after that, what I do, I subtract preliminary expenses, because preliminary expenses are valueless assets and these are not considered as assets. So 20,000 I subtract preliminary expenses. Preliminary expenses of W1 Limited only is given. As I told you, whenever we will compute capital employed for the purpose of computation of goodwill, never ever you are going to consider non-trading investment. Correct? Whenever we compute goodwill, whenever we compute capital employed for the sake of computing goodwill, never ever non-trading investments will be considered. It is very important to understand. So that is the reason non-trading investment I will subtract here. Why I am subtracting non-trading investments? Because we are computing capital employed for the purpose of computation of goodwill. Non-trading investments. Non-trading investments are 1,50,000 and 50,000. Similarly, any non-trading asset would have been actually subtracted. Any non-trading asset. Non-trading asset like any non-trading asset. For example, you have kept There is no non-trading asset in this question. Suppose if you are having a piece of land or plot of land and you have kept it with you for the purpose of sale in future, that means your intention is not to use this piece of land or plot of land for your business, so it will be considered as non-trading asset. Similarly, work in progress or asset under construction. Work in progress is nothing but asset is still under construction. Because these assets are still in progress or under construction, they cannot be considered as being utilized by your business. So that is the reason when we compute goodwill, in that case also, and especially in order to compute goodwill, when we require capital employed, we require, of course, all the assets, but when we take the assets, we have to be careful that valueless assets will never ever be taken. But besides that, non-trading investment, non-trading asset, and work in progress are not considered. Correct? So, 15,70,000 will become total of asset side. Total of assets which we are considering. And 7,30,000 will be assets of W2 Limited, which we will have to consider for the computation of goodwill. Is it clear to you or not? Now, after that, what you are supposed to do? After that, of course, you will have to subtract the liability. As far as liabilities are concerned, because ultimately we have to compute the capital employed. In order to compute the capital employed, now I will subtract creditors. Creditors of W1 Limited are 60,000. Of W2 Limited is equal to 50,000. We will subtract provision for tax. Provision for tax is equal to 90,000 and 50,000 once again. Then we will subtract, there was another liability, 12% debenture. Of this company it is 2 lakh and of this one it is 1 lakh. Correct? After subtracting these amounts, we will get 11,80,000. From 15,70,000, I have subtracted 3,50,000, and similarly, I will subtract 2 lakh from 730. I will get 5,30,000. So this is my operating capital employed. After having computed the operating capital employed, next step is calculation of average adjusted profit. Average adjusted profit. In order to compute the average adjusted profits, correct? First of all, you take the total of the profits which is given to you, total profits. So profits of last 3 years of W1 will be 6, 7 plus 5, that makes 18 lakhs. And of W2 Limited, it is 2 lakh, 250 and 150. That means 4 plus 2, it is 6 lakhs. Correct? Then I am going to divide it by 3 to get the average profit. So average profit will be equal to this much. Average profits 6 lakhs and 2 lakhs. 6 lakhs and 2 lakhs. Correct? 6 lakhs and 2 lakhs. Once we have computed the average profits, now in this case, I will have to subtract income from investment. Because investments are non-trading, correct? So whatever income we earned on those investments will be considered as non-trading income. So obviously I will have to subtract that. And as far as investments of W1 Limited is concerned, you can check it in your balance sheet. It is 1,50,000. And it was given to us in the question that it fetched a return of 20%. So 30,000 I am going to subtract. Since I am subtracting it from average profit, I will simply subtract 30,000, correct? Similarly, investment of this company was 50,000, and return given to us was 12%. So 6,000 I will subtract it. So now we are in a position to find out average adjusted profit. Average adjusted profits will be equal to 5,70,000 and it will be equal to 1,94,000. So we have computed the amount of profits. Is it clear to you? Now all we need to do is to find out the capitalized value of these profits. Capitalized value. Capitalized value, what does it mean? Capitalized value means amount of capital required to earn this much of profits. That is what we mean by capitalized value. Step number C. Capitalized value. In order to compute the capitalized value of profits, as I told you, what we simply do, we divide the average adjusted profit by the normal rate of return. Normal rate of return. Average adjusted profits are also pre-tax, and at the same time, as we saw, in this case, even normal rate of return is also pre-tax. So we need not require to do any adjustment here in this particular case. So what I am going to do is, I will compute for F1 and F2. Sorry, time and again I am writing F1 and F2. It is W1 and W2. So 5,70,000 is the profit of this company and 1,94,000 is the profit of this company. I will divide it by normal rate of return, which is given to us as 20%. So by dividing the average profit, correct, by your normal rate of return, what we get, capitalized value. This is capitalized value. I told you what capitalized value signifies. Capitalized value signifies the amount of capital which would be required by other firms to acquire this much of profit. Correct? Capitalized value. So now we are in a position to, this is actually your capitalized value. Capitalized value. And from this value, if I am going to subtract actual operating capital employed, actual operating capital employed, which we computed under first step. Under first step, we computed our actual operating capital employed was 11,80,000 and it was of 5,30,000 under the first step. That means we are earning, or we are capable of earning this much of profit by employing this much of capital. But other firms would require this much of capital. That is what we mean by capitalized value. That means our actual capital is this much, but actually this capital's value is equal to this much. That is what we mean by capitalized value. Anyway, by subtracting actual capital employed from capitalized value, we get the amount of goodwill. So goodwill will be equal to 16,70,000 and 4,40,000. 4,40,000. This is how you have computed the amount of goodwill in this case. Now you have computed the amount of goodwill. Your next step is to compute intrinsic value of share. In order to compute the intrinsic value of share, first of all, you write goodwill so that you shouldn't forget to write it. Because you will have to consider the goodwill now 16,70,000 and 4,40,000. Besides that, Now you start simply writing all the assets which are given to you. For example, fixed asset given to you of W1 Limited is 10 lakh, and of this entity it is 4 lakh 50, and so on. Rest of the things you can manage it by yourself. Similarly, then we were given investments. As far as investments are concerned, in this case, investment is equal to 11 lakh 50. Remember one thing, 1 lakh 50. While computing goodwill, correct, when I took assets, I didn't take investment. Otherwise, whenever we will take into account asset, we will consider investment, whether it is trading or non-trading. For example, valuation of shares now we want to do, so I will consider investment irrespective of the fact whether it is trading or non-trading. Only for computation of goodwill, investments, if non-trading, will not be taken into account. Otherwise, whenever you will write assets, you will consider investment also. 50,000. Stock, 1,60,000. Stock, 50,000. Lots of assets are there. Debtors, 80,000 and 90,000. Advance tax, 60,000 and 30,000. Bank balance also, bank balance 2,30,000 and 1,10,000. Less liabilities, 12% debentures, 2 lakh, 1 lakh. Now this sheet is exhausted. Then the next item will be creditors. Next item is creditors. Amount of creditors is equal to 60 and then 50. So all these formalities we will have to go through. Then provision for tax, 90,000 and 50,000. So by subtracting liabilities from total of your assets, you will ultimately get net assets for shareholders. That is equal to 30 lakhs. Or should I say, you must get a figure of this one. 30 lakhs and 10 lakh 20,000. No preference share capital is there. So these are also net assets for equity shareholders. So we can simply now divide it by the number of shares. Now as far as number of shares is concerned, number of shares. Total number of shares of W1 Limited will be 80,000. And of this entity it must be equal to 30,000. So ultimately now we have been able to find out the intrinsic value of share. No more this sheet is required. So intrinsic value of share, 37.50 and 34. 37.50 and 34. Then you will compute the amount of consideration. Consideration. This is your step number E. Consideration is nothing but net assets of W2 Limited. Net assets of W2 Limited is equal to 10 lakh 20. Now I want to know actually how many shares W1 Limited will have to offer to discharge the consideration. So I will have to divide it by 37.50, that is intrinsic value of share of W1 Limited. intrinsic value of share of W1 Limited. Whatever figure which we would get, that must be equal to 27,200. This shows number of shares to be issued. So these many shares you will have to issue. Is it clear to you? Although the question hasn't asked books of acquirer, just to give you an idea, books of acquirer, all the assets which we have taken and which we have actually written while computing the intrinsic value of share, for example, goodwill, just have a look over here. All these assets we have taken over, 440, 450, 50, 50, 90, 30 and 1 lakh 10. So I will total it. Instead of writing them separately, you can write them separately. So I will write here identifiable asset. This is the first entry. Identifiable assets, account debit. If I will total all the assets of W2 Limited, 7,80,000 it will be. Then I am going to write here 2 liabilities. 3 liabilities were there, and if I will total those liabilities, 50, 50 and 1 lakh, it will be equal to 2 lakh. Then I will write here consideration. Amount of consideration is 10,20,000. Intentionally, just pay attention here. If I am going to total all these assets, correct, that will be equal to 780. And if I will total all the liability 1 lakh 50, 50, it will be equal to 2 lakh, then consideration 10,20,000. And I will write here goodwill. Actually, when I computed the total assets, intentionally, I did not took the amount of goodwill. Correct? Just to give you a little bit of what we call idea. So, if I would have taken goodwill, no balancing figure would have been there. 4,40,000. Now balancing figure will appear. What my point is, try to understand that. When I wrote all the assets, correct? Suppose if I would have written all the assets separately, goodwill, fixed asset, investments, stock, debtors, advance tax and bank, then automatically both these sides would have got tallied. Even that goodwill 4,40,000 would have had appeared. So just to show the amount of goodwill, actually, I took this way around. Now, consideration. Consideration of 10,20,000 you are supposed to pay 10,20,000. In order to pay 10,20,000 share capital, you are offering 27,200 shares, and 1 share of your company is equal to 10. So that will be equal to 2,72,000. Then you will have to write here 2 security premium, 27,200, because you are offering your share at a rate of 37.50. That means premium is 27.50. So that will be equal to 7,48,000. 7,48,000. This is how the entries will have to be done. Correct? And then, question had also asked to prepare the balance sheet. Balance sheet. As per division 2, we write assets first. I will write here non-current assets. Under the non-current asset, I will write here first property, plant and equipment. Under the property, plant and equipment, I write tangible fixed asset. 10 lakh is the value of tangible fixed asset of our company, W1 Limited, and we took over their fixed asset at 4,50,000. So in the outer column, I am going to write here 14,50,000 and so on. And so on. Generally under division 2, when we write property, plant and equipment, under non-current asset, then we write goodwill also. Now goodwill of W2 limited is 4,40,000. Financial assets under division 2, actually financial asset is a term which is introduced and it is basically meant for investments. Your investments were worth 1,50,000 and you took over their investment also. So now the amount of investment which will appear in the balance sheet will be equal to 2 lakhs. Then I will write here current asset, stock, W1 160, and we took over their stock at 50. So 2,10,000. Then debtors, $80,000 plus 90. Preparation of balance sheet is not a tough task. 70. Advance tax, $60,000 plus 30,000, 90,000. Bank, $2,30,000 plus 1,10,000, 3,40,000. Total is equal to 29 lakh. Similarly, you can prepare the equity and liability side. Equity and liability side. As far as equity and liability side is concerned, we first of all write equity. Under the equity, we write share capital. Under the share capital, we will write shares of W1 limited only. Don't write here share capital of W2 limited. We can take over their assets and liability only. We cannot take over their share capital. However, we have offered 27,200 shares for discharge of purchase consideration. So total number of shares will be equal to 1,07,200. And one share is of rupees 10 each. So in the outer column, 10,72,000 72,000 will appear. Correct? This much only, no? 3, right. However, in bracket you can write, out of these 1,07,200 shares, 27,200 shares have been issued for consideration for discharge of consideration. Correct? For discharge of consideration. So you can write it this way in bracket also, just to give a good impression to the examiner. Other equity. As far as other equity is concerned, security premium. 27,200 shares we just offered, and some of those shares were at a premium, and premium amount was 7,48,000. Then our general reserve, we will not add the general reserve of W2 Limited, correct? Our general reserve is 3 lakhs. Our profit and loss account is 2,15,000. And remember one thing, preliminary expenses which is appearing in the balance sheet towards the asset side, I subtracted it from here. Correct? Preliminary expenses as far as possible should be written off. So, your other equity will be equal to 12,78,000. 12,78,000. Then you will write here liabilities. Under the liabilities, you will write here non-current liability. Non-current liability is 12% debentures. Actually, 12% debentures of your company is 2 lakh. And 1 lakh is the what we call of other company. But I am not writing here 2 lakh of our company and 1 lakh of their company. Actually, I am writing simply 3 lakh plus 0. Now you may wonder actually why. Because after taking over their debenture, correct, where that sheet is, when we pass the entry, see here under liabilities, that means we must have written over creditors, provision for tax and debentures. After taking over their debenture, it was given in the question, in the very first line it was given that W1 Limited has discharged the claims of the debentures. So that means we have discharged their debentures and we have issued to them our debentures. So instead, what will happen? Our debentures which were appearing in the balance sheet at 2 lakh will move up to actually 3 lakh. That is why I have written here 3 lakh. Then similarly, current liability. Under the current liability, there are 2 liability creditors. Amount of creditor will be equal to creditors. Where is that figure? 60 and 50,000. 60 and 50,000, 1,10,000. And then we have provision for tax. Provision for tax is 90,000 and 50,000. That is 1,40,000. So ultimately total must be equal to 29 lakhs. Correct? So I told you that in this session we are going to cover up some questions which happens to be pretty long questions, no doubt about that. So these are the things which I wanted to discuss in this particular session, and we have covered 2 very healthy, significant questions of your module also. In fact, we have covered almost every question of your module, and whatever remaining shall 2 will also be what we call covered up, no doubt about that, but shall meet you now in the upcoming session.